The return on equity is rather similar to the return on assets. However, the return on equity specifically focuses on the return of one group of the business, financier, the common stockholders, or the owners of the business. The numerator of the ratio is net profit minus preference dividends, and the denominator is average common stockholders' equity. The ratio is given as a percentage and represents the return that the business achieved using the funds that the owners have put into the business as well as the earnings of the business. As with the return on assets, the return on equity is a simple measure of performance over time and between businesses. There is also a key relationship between the return on equity and the return on assets. So if the return on equity is higher than the return on assets, then this means that the business is generating higher returns for its shareholders than it's paying in interest. In effect, it is successfully leveraging borrowed funds to level your result. That is, you can achieve higher return that would be possible from founding the business from retained earnings or from the business earning in general. So for the formula, as we see, you have to take the net income minus preference dividends, all divided by the common stockholder equity at start of period plus common stockholder equity at the end of period divided by 2 to finally find the return on equity. So let's take an example. In this one, we have 1 million of net income, preference dividends of 15,000, common stockholder equity at the start of period 8 million and 9 million of the end of period. So the return on equity will be 11.17%. So what this number means? It means that a return on equity figure of 11.17% means for every dollar of common stockholder funds, the business is returning 11.17% of profit for the owners. So what it means if the return on equity continue to change over time, a rise in return on equity is a very good sign. Similar to the return on assets, it generally means that management has improved the overall performance of the business on behalf of the stockholders. So this is most likely because net profit has increased in relation to common stockholder equity, and a higher net profit will all else equal, it's always a positive. However, the return on equity can be manipulated by increasing liabilities deliberately with a corresponding decrease in equity. This can be done, for example, by putting all income and expenses on credit. This reduces equity and increases liabilities. Then, with an equal profit as previous periods, the reduced equity will have the effect of increasing the return on equity. Whether this type of increasing is positive is less certain. That is why the relationship between return on equity and return on assets must be examined. Only if the return on equity is higher than the return on assets, then is the new increased level of liability is being managed well. For the reverse case, in general, you don't want a fallen return on equity. This normally means that net profit has fallen in relation to common stockholder equity, and this is obviously not a good sign and not good management on behalf of stockholders. There is an important valuation concept that relates to the return on equity that is worth mentioning. If a business can generate a return on equity which is higher than its cost of capital, then in theory it is creating value, and it is vital to any business as the quest for value creation is fundamental premise of any business. So in theory, if a business can create value, then its stock price will be higher than the book value of the shares. Now with the drawbacks of the return on equity ratio. So the biggest drawback has already been mentioned in previous sections. While the ratio is a measure of performance, the level of debt and liabilities can alter it, and debt is primary reason for most corporate collapses.